Our overall thesis right now is the continuation of a global slowdown. So it's global slowdown, not global recession. Understand that, and the dynamics that will potentially push governments to do things is crucial for the global slowdown story. I think that what the ECB will do will start buying debt again. I think they'll reinstitute QE. Who's going to buy Italian debt if not the ECB? In Russia, but we think that it will. So we're pitching buying sovereign debt, particularly in Russia. No, I think that they missed it. I think that to understand it, you have to understand how models work. Models work by fitting data. If you don't have stimulus, GDP falls. So the models will be wrong because they're fit on the wrong set of data. The growth projection of China of 6% is just wrong. Once you have economic slowdown, you have the political capital to do anything you want. Trillions and trillions of dollars that are going to flood that system if they go the direction of stimulus with credits. But I don't think they're going to do it. I think they're going to lower interest rates. It's difficult to envision that the Trump administration, or for that matter, the US in general, will accept any kind of concessions the Chinese will make, because they're not going to make any concessions. They can't. And the only way that they can achieve their goals, which is essentially taking and moving their manufacturing process to a much higher end and plugging it in China and make it domestically oriented in a 10-year period, means that they have to steal it. If you think that Europe has issues with Google and Facebook, it pales in comparison with what the Chinese are doing in China. The core of the debate that's going on right now in the political realm of the US is about bigness, dominance of a Facebook and a Google and Amazon for that matter. It's less of an issue around invasion of privacy, which is more of a European issue. The argument is you had a debt bubble in the US. I anticipate debt to actually shrink versus asset values continuously. So I think corporate credit is cheap, actually. I'm Alan Brazil. I started a firm called SOM Macro Strategies about 2 years ago. Prior to that, I was at Goldman Sachs for 22 years. Of that, the last 10 years, we're head of a group looking at macro strategies across assets and looking for asymmetries within those markets. My background as an economist, as a trader, and as a research person, as well as managing risk, gives me a unique perspective about looking for ideas, and particularly ideas that create those asymmetries that people are trying to achieve. SLM Macro Strategies was named after a piece that we created at Goldman called State of the Markets. And the State of the Markets is really a compendium of macro themes. At the core of those themes was the ability to identify trade ideas. And the core of what I do is, after you identify those themes, is we build a fundamental economic framework. Because the belief is that of all the various trades that you could do in the macro space, fundamental economics ultimately matter. And the key for what we do, and has been for the last really now 11 years, is to identify when it does matter. So crucially, we, with our economic framework, identify catalysts, that is potential repricing events. If we can identify that within a year, then we have a trade. If we can see how the market's pricing that idea, and we can find that 2 to 3 to 1 payout. We have 10 to 15 trades a year. We look at just about every macro theme out there. We create economic frameworks around those themes. And if we can find a catalyst, then we can identify trades. If we can't find a catalyst, then we don't have a trade. So we constantly monitor these theses. So that's why we're so unique in the sense that we're not trying to do everything. We're trying to identify those 10 to 15 asymmetries that are created a year. Historically, we've gotten roughly about a 2/3 hit ratio. So it's been a pretty successful strategy. And it's not something from the standpoint of historically, the power of understanding economic fundamentals and to identify catalysts. You're not forced out of trades as the market moves against you, as well as you don't necessarily get out of trades even if the market moves in your direction. Without the catalyst happening, then you still have a trade. So it doesn't matter in the sense of, at sometimes we do lose, in the sense that the catalyst does happen and we don't get the realization and we're out of the trade. Our clients run the gamut from real money investors to hedge fund investors, from macro strategies to currency strategies to even long-short equity strategies and credit strategies as well. Our fundamental framework can identify ideas in all those spaces. And even if, from the standpoint of, if you're a credit fund and our trades in a theme are equity, it still gives them insights into how the macro themes are going to play out. So it's really a function of the ideas and how we look at the world, and quite frankly, how they try to interject me into their thought process in terms of identifying trades. Our overall thesis right now is the continuation of a global slowdown, not just in the US, Europe, China, Japan, the whole world. In a world that, without government stimulus, monetary stimulus, the underlying economic dynamics are substantially slower than even current levels. And how we identify is across the board, whether it's in Europe, we look at it from the standpoint of Europe is slowing. Ultimately, the ECB is going to have to react to that, as well as the potential pressures from the periphery, again, Italy, again, forcing the ECB and potential government stimulus to offset that. So we're setting up from the standpoint of we're still pitching weaker euro against the dollar, as well as lower rates, particularly in the long end of the curve in Europe. In the US, what we argue is that the economy is going to slow. It's slowing already, obviously, from the standpoint, even with the strong labor market, as the physical stimulus of 2017 and 18 ebb. And that, along with the pressures in the rest of the world, and I'll talk about the trade issues in a minute, are going to force the Fed to cut rates. So we have a kind of buying receivers in the front end of the curve in the US, as well as you can buy curve caps. Both, I think, are very compelling trades. Overall, clearly what people are talking about today is the trade war potentially with the US and China. What we've identified, and we have last year, is how difficult any kind of agreement is going to for China and the US to come to any kind of realization. The idea is that if you understand the Chinese motivation for doing what they're doing, it's difficult to envision that the Trump administration, or for that matter, the US in general, will accept any kind of concessions the Chinese will make, because they're not going to make any concessions. They can't. The economic dynamic of China is that it's not what it was before. That is, the tailwinds of population, tailwinds of low-cost production, the tailwinds of building out a international trading global value chain, all that's dead and is slowing, which means that China has to find a different way to grow. And that's why if you understand China, you understand the importance of their policy of Built in China 2025. And the only way that they can achieve their goals, which is essentially taking and moving their manufacturing process to a much higher end, essentially taking the technology to the US and Europe and Japan and plugging it in China and make it domestically oriented in a 10-year period, means that they have to steal it. And that's one of the reasons, and really the primary reason, that it had such significant pushback from the developed world, and that's the outcome of that is tariffs. The goal is not to close the trade gap with China. The goal of the trade war, the economic war of China and the US, is to get the Chinese to stop stealing technology. And that's to come up with that kind of agreement, given the history of the lack of any kind of enforcement mechanism, or for that matter, for the Chinese to follow any kind of enforcement mechanism, means it's not going to happen. So kind of the underlying euphoria of that's happened in the last few months, and more recently it's changed obviously, is that the belief that somehow Trump will agree to a trade agreement with China. I just don't see that happening. And our trades are weaker renminbi accordingly, as well as we think that ultimately China will have to go the direction of stimulus. So our idea is not so much it's global slowdown right now, and the market's going to reprice based on that, but we're also going to trade the upside. That is, when it's slow enough to get governments to implement stimulus, whether it be the Chinese, US, Europe, is that our positioning will be just the opposite of what we have today. So it's really identifying these macro themes. They're driven by economic fundamentals, and to understand what are the catalysts for things to happen and to position accordingly. I would say overall our trades are roughly about, we have 5 trades. Historically, we had run 7 or 8 trades at a time. So on a relative basis, there's still a lot of noise in the system that we haven't really identified catalysts to reprice things. I think one of the more out of the consensus trades that we are recommending today is buying Russian local currency sovereign debt. We think it's cheap. We think that Russia is not really an emerging market. We understand the repricing that occurred back in 2015 and understand the currency at 60, 65, 64 is substantially half of where it was back in 2014-15. I think the error in looking at Russia is that the depreciation of the currency, the problems of the economy, was driven by sanctions. It was not. It was driven by lower oil prices. If you remember back in 2014 and 15, oil prices are back. We identify that as a repricing event that hasn't happened in Russia, but we think that it will. So we're pitching buying local currency debt, sovereign debt, particularly in Russia. To understand it, you have to understand how models work. Models work by fitting data. The data that has been created in GDP, for example, in the world since 2008, has been kind of biased upwards, if you will, by government stimulus. The markets don't identify the factors that drive the above normal GDP growth, but rather they just price in and use the data from the higher GDP levels. So we identify if you don't have stimulus, GDP falls. So the models will be wrong because they're fit on the wrong set of data. And I think that's where I think the biggest mispricing in the markets is that underlying GDP growth is nowhere close to where it is today. That is, it will continue to slow, not necessarily go to recession, but slow. The growth projection of China of 6% is just wrong. Over the next few years, it will clearly, and if, in fact, there's a piece that the Brookings Institute put out a few months ago that really argues that Chinese growth is closer to 4, and that's going to slow even further. US and European growth will slow even further from current levels. So it's global slowdown, not global recession. Understand that, and the dynamics that will potentially push governments to do things is crucial for the global slowdown story. The key for getting the Fed, the government, ECB, Bank of Japan to do things and to put in stimulus in the system is economic slowdown. Once you have economic slowdown, you have the political capital to do anything you want. And that's been the history since 2008. So I think the Fed, if you look at it from the standpoint of they've raised rates, they've stopped QE, in fact, rolling off the balance sheet, it's a significant tightening of monetary policy versus even the ECB and the Bank of Japan. So of all those institutions, the Fed has the most room to move. And once the economy slows, you're going to have that ability to do it. And the key for the U.S. is really one, if you look at the labor market and argue that the labor market's strong, so the economy would be strong. Look at manufacturing PMI today. The U.S. economy is slowing. That will ultimately lead to slower growth in the labor market and weakness, and that'll give the Fed the time to, or the political capital to lower rates. The ECB, you're going to have pressures from two things. One is clearly the continued deterioration of economic growth in Italy, which is going to put pressure on their ability to hit the deficit targets, which will force the ECB to do something, as well as from the standpoint, I think that what the ECB will do will start buying debt again. I think they'll reinstitute QE. Who's going to buy Italian debt if not the ECB? And that's going to be the pressure point that'll get the ECB to do more. Obviously, plenty of noise around the ECB, not least which is going to run it, as well as the European Union elections. But I think at some time in the next 6 months, they'll be forced to do it. The market's already repricing rates lower, and I think the ECB, the euro will certainly start to weaken accordingly. So I think there's political capital. The answer is that they clearly have tools. Will prevent the significant slowdown in the next couple of years? The answer is unless they back away from the support of the state-owned enterprises, it's unlikely to reverse that. The argument that they've lowered the reserve requirements is a way to increase credit and support growth in China. That's really not the core of what they're trying to do. What they're trying to do, I think, is that if you look at the monetary or the credit ecosystem of China, it's basically the large city banks have substantial deposits and substantial reserves. They lend money to the regionals, the province banks or governments that need the cash. So what lowering reserve requirements essentially frees up more reserves from the large city banks to lend to the province and the regional banks to allow them to lend. So that's kind of how the ecosystem works. The problem is, what are they going to lend to, and how does that create economic growth? So from the standpoint, are they going to continue to build stuff? Of course. But the problem is there's such a large economy now to actually move the needle. means a substantially bigger credit stimulus every time around. Keep in mind, this economy already at a kind of a steady state is originating roughly 35% of GDP in credit growth every single year. That's not even a pulse. The pulse will get it close to 40 or 50%. You're talking about trillions and trillions of dollars that are going to flood that system if they go in the direction of stimulus with credit. It's very difficult, given the size and the kind of sophistication of that economy, for that money to be deployed in China and creating growth. And that's why you have the leakage. So yes, they do have the capacity to do some things in terms of credit stimulus, but I don't think they're going to do it. I think they're going to lower interest rates. I think they're going to try to direct credit towards kind of high margin and high productivity endeavors, such as robotics, which is one of their 2025 initiatives. But all of that doesn't really move the needle all that much. But I think they'll do it. The goal of 2025 in China is technology, and technology that includes AI, includes robotics, includes data, includes high-end manufacturing. All of that's important. I think that as articles start to be written about the potential of AI to have a significant impact on societies, both good and bad, it creates all sorts of issues. If you think that Europe has issues with Google and Facebook, it pales in comparison with what the Chinese are doing in China. So that creates a barrier, and I think, again, it's a barrier that would be very difficult to surmount. So what's happening, there's those of you that know the book, The World is Flat. The idea is that the world becomes less flat. That is, you become ecosystems, that is, become more independent. And technology allows you to do that. You don't necessarily need the ability to build something in China to deliver to the US. If, for example, you have 3D printers, the technology is creating the ability to separate. And I think that's ultimately what's going to happen. So technology is important. If you think about it from the standpoint as well, the Chinese have focused on robotics. And what they did in steel and what they did in other aluminum and other industries are doing now in robotics. That is, they're creating the capacity to produce robotics that's going to swamp the world with robots. They can't absorb them. But crucial to that, and this distinction, is the ability to build a car with robots is one thing. The ability to do something more sophisticated is another. What the Chinese are building are things that can build cars, but they don't yet have the technology that the Germans and Japanese have in robotics that have very flexible ways to move your arm and to do things. That's what they want to get to. So technology is huge, and AI is certainly part of it. The core of AI is data. The more data you have, the more ways you can identify kind of themes and how things work. So I think AI will continue to be a big battle for the US and Europe, and for China. If you look at the documents that have been produced by the administration as part of their 301 tariff arguments, as others as well, the amount of inroads the Chinese are having in US AI is huge. So I think, again, there's going to be a battlefield about AI. Who's going to have access to it? But data is crucial for it. So I think technology is important. Well, I think that the core of the debate that's going on right now in the political realm of the U.S., my own opinion, is one of the concern about bigness, dominance of a Facebook and a Google and Amazon, for that matter. It's less of an issue around invasion of privacy, which is more of a European issue. I think historically the U.S. just doesn't like big things, and has a natural reaction is things that grow and grow in a way that are basically uncontrollable. It creates real fundamental issues. Having said that, things like Facebook and Google are really enormously, not just profitable, but interesting institutions of how we spend our lives, and very difficult to measure entirely the impact it's had, but it's been huge. But I don't think they're shooting ourselves in the foot. I think that what tends to happen in Facebook and Google is that you become more, how to put it, more like Microsoft. That is, you become less of the innovator because you're so big. So I don't think that that's an issue. I think that the Europeans bring up privacy issues, which are a more important one. And although in the US we don't really care all that much, but ultimately we will as well. Particularly as more of it is brought out, is the ability to identify, what the Chinese have done for facial recognition, for example. All those things are what are going to become an issue in the U.S. But how I look at, and from the fundamental basis, is the Google and Facebook are dramatically different than Amazon. Google and Facebook is absorbing or essentially taking on advertising revenue and getting better at it, being more productive. But there's just so much revenue of advertising in the world, although it is growing. So they're just getting a bigger and bigger share of it. Amazon's taking out sales. That is, they're taking out retail. They're going into areas that, like grocery shopping, is that they're revolutionizing the way that people consume. And so that, from some sense, is a much bigger platform, a much bigger revenue source than I think Google and Facebook. So I think they're great. I own at Facebook. I mean, I own all of these, but I'm not. I think it's a political issue more than an economic issue, at least right now. Yeah, I think the simplest way is to buy debt. I think corporate debt, even, but certainly Treasury debt. I think if you look at Europe, if you're not going to emerging markets, you certainly can think about buying Italian debt. Is that all yields are going to collapse once again. So just buying debt is certainly one way of doing it. Another framework that I've used a lot, and not recently, but I have, is one of credit. And the idea around credit is that, when I wrote a piece a little while ago about it, which is, the argument is you had a debt bubble in the US. You had a significant growth in credit, in debt, corporate, non-financial corporate debt. And the argument that debt is being used for corporate buybacks and all that's bad. However, from my experience at Goldman, where prior to running this macro strategy group, I ran mortgage strategy. So from that standpoint, I know a lot about credit, a lot about how you, particularly from asset lending, from the standpoint of what is from a mortgage perspective, what are you borrowing against? It's an asset value. I think a more fundamental view of credit is not debt versus cost of that credit, but rather leverage ratios. That is, what is your debt to equity ratio? And those of you that are familiar with finance, that's a crucial element for determining default, which is the Merton model and other versions of credit and credit cost. From that standpoint, if you look at the debt to leverage ratio, or essentially the debt to asset leverage of U.S. corporations, it's actually been shrinking. And it should be shrinking. The only reason, fundamentally, that you have leverage on a balance sheet is the ability to shield income or revenue by your interest deductibility. And as interest rates come down, the value of debt as a interest shield goes down, and particularly with the cut in corporate tax rates in the U.S. more recently, again, reducing the incentive to have debt, I anticipate debt to actually shrink versus asset values continuously. It's one reason that explains why the debt to asset ratio in Europe is so low versus the U.S. It's because they have, on the margin, lower corporate tax rates. If you look beyond the tech world, where there's lots of things going on, there's really not a whole lot of debt, if you will. If you look at it from the standpoint of sectors that have high leverage ratios, if you will, debt to asset value, there's been some shrinkage, but not a lot. The corporate tax reform is, by and large, a year and a half old. It's actually been implemented. So we haven't seen a big change yet, which is, to some extent, not a surprise, but ultimately I believe it will happen. What you can't explain by that model and that framework is leverage loans. You know, why there's really no economic benefit to having that degree of leverage on a balance sheet